Hi, I'm Winston, and welcome to the Real Estate Template. Today we're joined with a good friend of mine, Rob. Rob Dodd. Rob, we met where?
We met for the first time as part of a mastermind group that we're both part of. I think the first time that we met was actually down in Mexico. Believe it or not, that was coming up on a year ago. Yeah,
that was in August. And we met. We joined the collective group, which is part of a mastermind with Ken McElroy and George Gammon and Jason Hartman, and have just developed a relationship. He's a local guy here in Nashville, local investor who has a job. I just want to get out. I want to talk a little bit about what he does, how he does it, where he comes from, how to get to where he is today. Where is he today? So I'm going to let you just start, maybe a little introduction of yourself and
sure. Yeah,
who you are, what you are.
Looking forward to it. All right. So my name is Rob again, and yeah, as you might be picking up from the accent, definitely not from around here in Nashville, Tennessee.
I agree.
I'm still working on the accent, but I don't know. After living here for a little over 12 years, I think that may be a lost cause. But anyway, rewinding the clock a little bit. So I was born in the States. My parents met at the University of Rochester. So I was born actually in New York City before they ended up moving back to South Africa, which is where I'm from, where I'm raised. And yeah, have been living here in the States, let's see, about coming up on 15 years now. 12 of those have been here in Nashville and a few other spots before that. But yeah, so ultimately the story is, so I work for an engineering consulting company.
Are you an engineer?
I'm actually not an engineer, no. I studied computer science at the University of Cape Town, and thankfully never really worked for too long in the software space. Truth be told, I was never really cut out for it. But ultimately that background gave me a lot of exposure to just business in general. It was computer science, but it was a business degree, and computer science just happened to be the major.
So basically you're a normal guy.
I don't know if I'd go that far, but yeah.
A little extraordinary or extraordinary?
Well, it depends who you ask. But yeah, no, I mean, just a normal guy. I mean, went to college, got an undergrad degree, and yeah, I've just been kind of working since then. I still work for this engineering consulting company now. I'm in sales, and yeah, just been keeping that going, and then building on the side a real estate portfolio that ultimately, hopefully, once we get there, will be able to fund my lifestyle to a point where if I choose to continue working for this engineering consulting company, great. If I don't want to do that or want to focus on something else, then the real estate portfolio will allow me to make those sort of choices and have that sort of freedom of choice in terms of what we want to do and who we want to do it with and ultimately where.
Okay, so ultimately your goal in the real estate sector is for the passive income, so that I guess you can make the same amount of money while you're sleeping as you make while you're awake, and nothing ever changes from that avenue.
Exactly right. And I mean, I've been doing real estate now for quite a few years in some sort of shape, way.
What is quite a few?
So I bought my first house probably in like the mid 2000s. Back then, I didn't even realize that I was kind of like getting into the real estate game. But ultimately what that was after college, I took a few years off and I worked and traveled around the world, actually crewing on luxury yachts internationally. And so I was able to save up a lot of the money that I earned there, which was US dollar denominated, bring it back to South Africa.
Now, if you didn't understand what he said crewing on luxury lots. So he was actually a worker.
Yeah.
So worked for us.
Yeah.
Okay, well, I apologize. I struggle with the crewing. I'm not saying nothing about your accent, but making sure that the redneck folk out there can understand you also.
Yeah. So I was working on these yachts. They were incredible. We got to see some very cool places. But ultimately, at the end of the day, I mean, I was running around. I was cleaning up after people. I was fixing things on the boat, maintenance, taking care of guests, and yeah, very much just a working job.
So if you wasn't working, you wasn't making any money.
Quite right. But the whole goal of that, in addition to traveling and experiencing new places and so on and so forth, was just I was socking it away, man, just saving, all of this was tax-free dollars because we were working on international waters. So we were able to earn that money tax-free, which was a huge benefit.
So for the average person that's watching this video right now,
Yeah.
what you're telling them is if they want to do what you do, just join the military. They feed you, they house you, they clothe you, they take care of you. You spend 4 years socking away that money and you go buy some real estate.
Quite honestly, it's not that far removed. I mean, literally,
I'm just being sarcastic with it, but it's...
I mean, it's not that far from the truth, though. I mean, we would, we'd get taken care of. Like, we had a chef on the boat that would cook for the guests, but, we'd also get fed by that same chef. We had accommodation on the boat that we lived on, so you didn't have any housing expenses. And, they took care of your insurance, so all of this sort of stuff. So you effectively had a zero cost of living while you were working on these boats, and you were just able to save all of this money, which was fantastic. And at the time, it was an incredible opportunity, and it was a lot of fun. And, at the time, the exchange rate to the US dollar versus the South African rand was really favorable. So was able to save up those dollars, take them back to South Africa. And I ended up buying a 3-bedroom, 2-bathroom condo. And right when I started working, quote unquote, in the real world for a real job, and I just wanted to hang out and have fun and party with my friends. So I was like, hey, let me get this place. Let me fill it with a bunch of my buddies. And they ended up paying rent. Like, we had a great place. We had a great time, but they were paying rent that whole time. So that was helping offset my mortgage costs and my insurance and all of that other stuff relative to the costs of owning and operating that property. And I was living in it myself and having a ton of fun. So that's why I say I kind of got into it back then, not fully realizing the power of it and what it was ultimately going to mean. But once I started seeing those monthly checks come in, it was like, holy smokes, like, you can do this, and you can make some good money if you got to start
compound quick.
That's exactly right. That's exactly right. So, that was back in South Africa. And then after I moved to the States and got settled in Nashville and started to get my bearings and started to have success in my job, in my sales job and earning some commissions, very similar thought process. I was just like, let me just sock this commission dollars away and just start buying real estate. And so far it's been pretty good.
So how many properties do you own right now?
So I own 7 properties down in Chattanooga. That's 10 doors. So it's a combination of single family homes and duplexes. That brings it up to the total of 10. I've got 3 vacant plots of land. I've got 2 Airbnbs out in the Smoky Mountains, out near Gatlinburg. And then I've got 1 commercial property up in Milwaukee, Wisconsin. That's an office flex building. And so that's been my first kind of venture into more of the larger scale commercial type properties.
Okay, let me stop you right there.
Mm-hmm.
All right. So across the spectrum of real estate, you're in a lot of markets. You're in a lot of areas.
Mm-hmm.
So most of your rentals, are they all short-term, long-term, a mixture?
It's a bit of both. I'd say the majority are short-term. So that would be the 10 doors down in Chattanooga, Tennessee, just down the way from where we are right now. And those have been great. Those have been so good.
So in that perspective, do you have a property management company that manages everything for you?
I do. Yeah. So it's very, very passive in that respect, which is great because, my regular job keeps me pretty busy.
So
but
in the same sense, if you don't want to answer that question, say you don't want to, what type of return do you make on those, on a percentage wise of your investment? And let's go from a throw off numbers. Include everything as a whole.
Honestly, I haven't actually, shame on me for not having sat down and really calculated that. What I will say is, we can probably do it right here. So I bought that collection of properties down in Chattanooga. The first one that I bought was actually part of a parcel of 5 properties. So a single owner looking to offload a few properties all at once. Bought that collection, 5 properties. That was $350,000. The 6th property that I purchased down there was a standalone single family home. I purchased that for, let me see my notes here, for $60,000. So that's 410.
And 6 properties?
Yes. And then, yeah.
All right, you're not finding that deal today.
Look, this was back in 2019.
But you're not finding that deal today. But the deal you find today, 8 years from now, 10 years from now, will probably look very much like what he's talking about now.
That's exactly.
I mean, Chattanooga, the Knoxville area, it hasn't declined any. It has been just steadily rising in expense or in cost of what you're buying and what you're getting out of it in rents. So if it remains on the same trajectory as what we got right now, it would be the same thing. 10 years from now, I'll probably be able to talk about the same deal. I got some houses that I paid $15,000 for right now that are worth $200,000, but, and it's, I'm not afraid to buy the houses now because I feel like they look the same way. So, okay, just going.
Yeah, absolutely. And I mean, when you think about it, right, especially where we are right now in 2023 with inflation doing what it's doing right now is, I mean, you may buy these properties in 5 years' time if we have, I don't know, pick a percentage, right? Let's say an average of 4 or 5% inflation over that period of time, maybe a little more, maybe a little less. I mean, that will have an impact on your property value without a doubt. And that's just in 5 years.
So what would you say, what would you guesstimate your gross income on those 6 houses?
So,
here today?
Yeah, gross is probably, let's see, it's probably bringing in about $8,000 a month. So close on $100,000 a year gross.
Wow.
And yeah, that was probably all in, including that last property purchase. That was probably on about $450,000, $500,000 worth of actual, assets purchased.
And that has the last piece of property is just a piece of land?
Sorry,
No.
it's a duplex. That was the other one that I bought. And I actually found that one through my property manager. In fact, the last 2 that I purchased were through the property manager. These were properties that someone else owned, but he was managing them. And he called me up and said, "Hey, Rob, listen, I've got this other owner. He's looking to liquidate some properties. They're in the kind of areas that your other properties are in. If those are of any interest to you, let me know." And so I said, sure, send over the information, ran the numbers. They both penciled out really nicely. And so what's great for him is he gets to continue managing those 2 properties as part of his overall management portfolio. And I think he was able to, get a piece of the sale as well as an agent.
So you and I haven't discussed any of this prior to right now.
No.
So do you know don't tell me it, but do you know what your net number is right now, roughly on those? Don't tell me to know.
Yeah.
Okay.
Yes.
So I'm going to tell you, I think you're running, that puts you at a 20% gross basically.
Mm-hmm.
And I would say you're probably netting right now, probably about at least 15%.
Yeah, I think that's about right. So I think net income on an average year, granted, these are older properties, so sometimes you need to go in and you got to fix a water heater or a roof or whatever it may be. So there are some capital expenditures.
I mean, maximum
general, probably
maximum 30% growth, or
probably about
30% expenses on a house like that. Probably, I mean, somewhere around up in there if it's being well kept up.
Yeah, so I'd say net's off that 100 net, you're probably looking at about 20K. Yeah.
So what do you think on whenever you first bought them, what you think your return was at that point? Now that's just cash flow we're talking about on income. We're not talking about his appreciation he's getting every year. We're not talking about his principal reduction if he's got a note on him. We're not talking about any you in a decent tax bracket, so you're getting to write off your depreciation. So we're not talking about all that. We're only talking cash flow on that number right there of roughly 15%.
Yep.
So when you first bought them, would you say that you was making huge cash flow, or was you making 5%, 6%?
Yeah, it was probably closer to that once all was said and done, probably somewhere between 5 and 10, and now it's closer to, I'd say, about 20. So yeah, rents have definitely gone up pretty dramatically.
But that brings us back to where we are now.
Mm-hmm.
Now, when somebody goes in and buys a piece of property, the 1% rule. Everybody used to go for a 1% rule as that's the thing. If I can hit that 1% rule, I'm making money. Right now, if you run the number, I think we've run the numbers on more than 50 deals using the 1% rule. And basically the 1% rule nowadays makes you break even with interest rates at 7.5%. until interest rates drop back down,
Yeah.
then the 1% rule will start working. Probably when it will get down to 5% or somewhere up in there, it'll be a good rule again. But at 7%, at 8% interest, it's not a good rule. It's a good rule to get you in and tell you, I think at the 1% right now, it's going to pay its way. You may get a few $100s a month or a couple $100s a month, $1,200 a year, $2,400 a year. You're not going to get a ton of money, but you're going to get some good appreciation because the government's going to print money like crazy. And you get to use the principal reduction and the depreciation also, apart from that. But 5 years from now, that's when it starts kicking in. And if you can do a cash out refi prior to that and get all your money back out of it, that's going to change the numbers also at a lower interest rate. So it's not a bad time to invest right now. Your purpose may be different. You may look at it and your planning is not, hey, I'm gonna go ahead and increase my cash flow $4,000 a year. That's not going to happen probably right now on most of the deals we have in this area, and probably in your area either. But there's so many different ways to look at that.
Yeah, 100%. Cash flow is great, right? And that's certainly part of the goal relative to being able to resign from this job and have a steady stream of income that supports the lifestyle. So that's definitely a big part of the goal.
You make a decent amount of money a year. We're not going to talk about your salary. I have no idea what you make, but I know you make more than $20,000. So you're making a decent amount of money a year, and you probably find yourself in the mid-30 tax bracket. So if you're in the mid-30% tax bracket, your appreciation that you're writing off on your taxes every year is making you more than your cash flow, pretty close probably. And that's the cool thing about real estate is that depreciation. If you make a lot of money, if you're in a 10% tax bracket or 20% tax bracket, it's not comfortable, but it's not killing you. But you start getting above the 30% tax bracket, up to the 40% tax bracket, now it's a whole different story.
It stings.
40% of what you make goes to the federal government. Who wants to pay that crap?
I tell you, the biggest shock to me was, it used to be that I used to file my taxes and, sometimes maybe in a year I'd get a check back from the government. Now I'm writing checks incremental to what my employer's been siphoning off on the side and paying for my taxes. When you start having to write checks into the government in addition to what's already been pulled off your paycheck, that really stings.
So I paid
taxes. That's a lot of motivation.
I paid taxes to the government 1 year, and then we did our quarterly taxes all year long, paying what we were supposed to pay or what we felt like we were supposed to pay. Then I did my income tax end of the year, and I had to pay them an extra $392,000. So I had to write them a $392,000 check to the IRS for money that I worked my behind off for all year long. Most of it was capital gains that I made through day trading on that money. And there's a tremendous amount of risk in doing day trading. A lot. Most people, the majority of people lose everything they deal with on day trading. And I should have too, probably. I just got lucky. But, after I wrote that check, I tell you what, I've never day traded again. Because I took all my risk for the federal government. And I said, I won't do that anymore. That's if I can't walk away with the money, I'm not going to do it. But some depreciation at that time, a little bit more than what I had, would have been really nice.
Yeah, to help offset that.
So a lot of the people that are watching our videos are people they're very, very, very new to investing.
Yes.
They're trying to learn how to run numbers. They're trying to learn how to dissect the deal down. What would you say when you first started? How did you dissect that deal down?
It was fairly rudimentary. What I was doing is using...
Sorry, I got to get up because my dog's in the room here and he needs to go out and greet somebody.
We'll let him out. There we go.
Sorry.
Got to keep the dog happy.
Nick may edit that out and Nick may not edit that out. We'll see.
So yeah, in terms of just how those numbers were being run, initially it was a case of looking at these deals and saying, okay, something as simple as the 1% rule, like, will this pass the 1% rule? Will it? Yes or no? If it did, then okay, let's take a little bit further look at this. If it didn't, let's maybe not waste our time looking at it quite as closely. So that was kind of the first filter. And then honestly, there were just a lot of online tools that you can get access to that have these like investment calculators that you can just go online, plug in the various numbers relative to your purchase price, information about the type of loan, if you're going to finance that deal, how much are you putting down, at what interest rate, etc. What are your expenses going to run in terms of your taxes, insurance, electricity, internet, if you're providing internet and any other utilities as well. And basically these calculators make it nice and easy. They prompt you so that you don't miss anything out, number one. And then they generate a number for you. Just click the button and it'll generate, and it'll say, hey, this is the kind of cash on cash return that you can expect from this property based on the information that you plugged in. And there are a variety of places that you can find those types of calculators.
And how much do you trust that?
I trust them pretty good. Yeah, I mean, I've built my
90%, 95%.
I'd say higher than that. Yeah, I've built my own in Excel.
So I have never used what he's talking about. I did my own in Excel also.
Yeah.
When I first started investing, it was like throwing a dart at a dartboard. I didn't know what the hell I was doing. It was just like, oh, that looks like a great deal. Go buy it. And you buy it, and for some reason it worked out.
Yeah.
For some reason it worked out, and it worked out until it didn't work out. And then I lost a lot of money. I'm like, okay, that didn't work.
Yes.
And then I got some education. But that's cool if there's some stuff out there. I keep doing videos where I'm trying to teach people how to run the numbers themselves because I want them to understand how to run the numbers.
Mm-hmm.
But there's also tools out there to do it. But it's good. It's good for the tools are cool, but learn how to do it yourself. Also, don't just learn how to do it through a tool. What happens if that tool's not available? What happens if you never know who wrote the program. What if they missed something? You choose the wrong program. Just do your due diligence on all that.
No, that's 100% right. What I actually did was, I think initially I was doing kind of similar to what you were doing, Winston, in terms of just some basic Excel stuff. And then, I'd kind of calculate it out for myself. And then once I found out about some of these online tools, I was like, let me go and take a look. Let me plug in some of my deals that I've underwritten myself, plug those into those tools, and let's just see how close they are in terms of the answer that it spits out. And thankfully, they were essentially the same. So I guess my Excel math was right.
Huh.
But yeah, it is a good exercise to go through, and it forces you to understand when you're building that tool, okay, like here's how the numbers add up. Here is how we need to be looking at the debt service and what does that mean every month. And then when you're looking at your income relative to your expenses, what's left over, and then how do you actually sit down and calculate what your true return is on that invested dollars, so that you really understand the ins and the outs of the math.
So are you now, when you're buying property nowadays here recently, are you buying with cash or you borrowing money? And if you borrow money, are you struggling to get loans or the bank's working with you? Okay, what are you experiencing? That's experience.
So yeah, I went pretty heavy in terms of acquisitions in 2021. I have not purchased anything in 2022, just on account of 21 being such a big acquisition year for me. And it's been a case of essentially taking those assets. There were asset classes that were new to me, so learning those asset classes, optimizing those properties, and so on and so forth. So that's really been the focus of the last year and a half, to get those really humming as well as I can. But prior to that, it was predominantly, through bank financing. And back then, even though we'd had the initial COVID shock, thankfully they were still open for business, and they were very eager to help out. That's for sure.
So as you went into commercial, how do you like that compared to, we've only talked about so far the Airbnb portion, short-term rentals. How do you like the commercial compared to the short-term?
I really like it. It's different. There's some things that are better. I think there's some things that are a little bit more challenging, for sure.
Then you elaborate a little bit on that.
Yeah, sure. So from on the good side, this particular property is what's called a triple net lease property. So what that means is basically the rent that I receive from my tenant is the only thing that I've got to offset against that rent is my mortgage. So the tenant pays for the utilities, the tenant pays for the taxes, the tenant pays for the insurance on the building. I get the bills and I just pass them through to the tenant, and then I get reimbursed for that. So effectively, the cash that I get deposited in my bank account every month, the only thing I've got to worry about is my mortgage payment, and then what's left over is straight cash flow.
So what what kind of cap rate do you get off of rents?
So that property was purchased on a 6.5% cap rate.
So he purchased it off of a 6.5% cap rate, which means that you take the amount of net operating income and you divide that net operating income by the 6.5 cap rate, and that gives you the purchase price of that. So whenever he says he's buying at that cap rate, that's how they figure out the purchase price of that. Now, if you're going to do return on investment on that cap rate, then we would say it's bringing in X amount of dollars NOI, and we divide that by how much money you have invested in it, and that's going to give you your cap rate of what you're making off of it. Mm-hmm. So hopefully, if you buy at a 6.5 cap rate, hopefully you're getting a little bit higher on the cap rate for the thing. A 6.5 cap rate is a good cap rate on commercial property, especially in 2021. I mean, we looked at some stuff. Everything is in the 4s and the 5s, which if it's in a 4% cap rate, you are paying a tremendous amount of money, and you probably aren't going to make a whole lot of money off of that deal.
Yeah. So different types of commercial assets in different markets will dictate what that cap rate is for sure. So for example, if your tenant is Starbucks, right, and like that's going to be a very secure tenant, very
4%, 3.5%.
It's going to be a very low cap rate because that's such a stable tenant. Excuse me. If you got like,
and those come with about a 15 or 20-year lease. I don't know about yours. We can talk about yours in a second. But when you buy Starbucks or you buy Popeye's Fried Chicken or you buy Lowe's, they're going to come with a 15. If they're new projects that you're buying and just buying a real estate, they're going to come with a 15, a Dollar General, to a 20-year term that they're going to offer you, and they're going to want a renewal after that right there if they want to renew. And the rent increases, I know Dollar General, I don't think they do a rent increase for the first 36 months, and then they do a rent increase. And in the end, it becomes a great position to retire on and get that money. But if you're more actively working in your investments, you can make a lot more money with a different field. Now, buying at a 6.5 cap rate, I don't know about that.
Yeah.
That might not be the case.
Yeah. Well, I mean, so what was interesting about this particular deal is the rent that was in it. So it was a brand new lease. The tenant had a brand new lease, 10-year term with options to extend after that.
So your money is guaranteed from day one for the next 10 years.
Effectively. Yeah. Effectively. 3% rent increase built into the lease every single year, starting year one. Which was nice. But what was interesting about this one, and the reason that
let me make a statement on that. So you're locked in at 3% year over year over year. So his rents will continue up at 3% every single year. If we got a down year and the rents aren't good, he still gets a 3% increase. We got an up year where rents are supposed to be 8%, he still gets 3%. Mm-hmm. So across the board, it's 3% compounded every single year, which is, it adds up in the end pretty quick.
Well, I was going to say that's the key word, is compounded, right? Especially when you think about over a 10-year lease term before extensions and things like that. 3% compounded annually over 10 years is pretty decent.
Well, it's 50% more money, basically.
Exactly right. But ultimately, the thing that was the most compelling about this particular deal is the lease. The rent, the cost per square foot in rent that the tenant was paying, or is paying at the start of the lease term, was very low. It was about probably 60% of what market rents are in that area. And so while that might be a red flag, my point of view was, hey, I'm buying it at a 6.5% cap rate, which generates a decent return. If this tenant defaults and I have to put in a new tenant into this building, I'm going to be able to bring this new tenant in much closer to market rent. Mm-hmm. Now, all of a sudden, my net operating income, which was X at the beginning, just shoots up by X plus 30%, 40%. And all of a sudden, when you take that increase in your net operating income and you apply that 6.5% cap rate to it, the value of the property explodes. So that, for me right there, was the main reason that I ultimately decided to move forward on this deal. It wasn't necessarily the year one cash-on-cash return, but ultimately when you look at the upside opportunity or the value-add opportunity, plus the fact that there were annual rent increases every single year throughout the term of the lease, and the tenant also signed a personal guarantee as part of that leasing process. those were all reasons that ultimately got me comfortable with the overall deal and the reason that I decided to move forward with it.
No, I think it's a good deal. We're leasing up this building right now. We're going from single tenant to multi-tenant, so we're going to put probably at least 5 different tenants in it. And, the first tenant came in at one price. The next tenant came in at a different price, and now we just priced it out this morning. That was, the first tenant came in at $8.50 a square foot, I think. Mm-hmm. No, it wasn't. It was about $10 a square foot.
Okay.
And now we're renting, and it's just been in the last few months. We're renting now at $13.50.
Wow. Wow.
And so now, if I go to sell that building or this building, now I'm going to sell it, and whoever I'm selling it to is going to be able to look at the latest rents that we're getting out of it. And with those rents, they're going to say, okay, if they're getting $13.50 a square foot out of it now, I got a value add for all these other tenants whenever their term of their lease comes up. Mm. And I'm requiring a minimum of a 5-year lease, or I'm not doing anything. So,
right.
So we got to at least secure that for 5 years.
It's awesome.
And, it's amazing how fast that makes some money.
It really is. I mean, the fact that with these commercial properties, because of the way value is calculated using the cap rates, any small increases that you can make to your net operating income number have an amplified effect when you apply that cap rate. So even at a 10% cap rate, which is really high, if you were able to, let's say, cut your expenses, let's say you meter out your utilities for your new tenants, or if you're able to, increase rents like you're talking about. So whether you're increasing your income or whether you're cutting back your expenses, depending on what your lease structure is like, let's say you're able to basically drop another $10,000 to your net operating income line, which realistically in commercial properties isn't that hard to do.
No, it's not.
At a 10 cap, you basically take that, you divide that by 10%, and all of a sudden the value of your property is increased by $100,000 just by making a $10,000 improvement, right?
Yep.
So, when you start getting into these larger properties and you're able to drop another $100,000 or $50,000 to your bottom line, even at a very high 10 cap, those are real. That's real dollars in terms of the value of your property that you're driving up, and that gets amplified even more as you start getting down into the 7 cap, 6 cap, 5 cap, 4 cap arena.
So what kind of, and again, you don't have to share this with me, what kind of financing did you do? Did you do a lock fixed rate, 30-year note, or finance on that? How'd you do in your finance?
So I wish that was the case with the commercial property. Commercial properties are usually done a little bit different to residential. So residential, it's great because you can, generally speaking, lock in really low interest rates for a very long period of time. So like 30 years fixed at whatever the interest rate is. With commercial properties, depending on the type of commercial property and depending on the deal that you're able to strike with your lender, they will usually lock it for anywhere between, say, 3 years and maybe out to 10 years, depending on the kind of property and the quality of the deal. And then what happens is after that period of time, you have to go back to the bank and basically renegotiate a new loan once that original loan matures.
So that property you bought in 2021?
Yeah. So that one was locked in at a 3.75%. Yeah.
So if he bought it at 3.75 or percent locked in on his note, but bought at a 6.5% cap rate, so you got what was the spread?
Call it 2% round number.
A little bit over 2%.
Yep.
That he's making just off of the spread right there on the interest rates, and that's just going to go up from there by whatever the cap rate they go up on. So that's a good place to be. There's a lot of people that have done that, and then they come through that market, and then they call that note, or don't call that note, it comes up and they got to reapply for it again. Mm-hmm. Now it went up to an 8 cap or a 6 cap or a 7 cap, and it takes away all the money they're making whenever they got to go in and refi. So you got to be careful when you're going in and you're locking something in on a commercial basis, mm-hmm. and they're going to give you a 5-year call. I think a 5-year call is extremely common, but it is extremely painful because you really don't know where you're going to be in 5 years. If you raise the rents 3% every year, and then your interest rates goes up 1.5%, 2%, it's done taking all your money away from you, all your profits. You're right back to where you were. and you should be in a pretty good shape because hopefully we'll see interest rates start dropping back down again. But I think inflation is going to still run rampant across our country, and the rents are going to keep going up, and the dollar's going to keep going down. So, your spread should be fine. But okay, so we talked about your short term. We talked about your warehouse, not warehousing, but your retail. Now you got long term also.
Mm-hmm. Yeah. So the long terms are the ones down in Chattanooga. So those are the ones that we talked about at the beginning. Those single family homes and duplexes.
How are they
that are down there? Those are great. Those are the ones that we ran the numbers on just live a little while ago, and yeah, that's the one that I think is netting probably about 15 to 20% just right now. So those have been great. And what's been nice about those ones is, despite the pandemic, these particular properties, I should have said earlier, these are properties in working class neighborhoods. These are not fancy homes. I mean, 5 properties for $350,000.
Well, but I'm gonna tell you, I don't want to invest in fancy homes. I don't.
Either.
I mean, we had a fancy home that we were Airbnb-ing, making good money off of it. It did not interest me at all.
Yeah,
I could not wait to get rid of that house.
Yeah,
and I want to deal with working class people because, the working class people, they're gonna be here. They're still here. They're gonna be paying rent, and you go to a high end house. That's the first house that's affected when the economy drops.
exactly.
I'm gonna quit. I'm not gonna rent this big house. I'm gonna rent something smaller. I'm not gonna do this. I'm gonna do something smaller. If I'm building a house, when I build, I always build something in the mid-range. I don't build anything on a low scale, but I don't build anything on the high scale either.
Mm-hmm.
I build something that I want at least 60-70% of America to be able to go buy.
Mm-hmm.
And if that way I got a good pool of buyers. If you build something that only 1% of the country can afford, then that is all you got for market. You got 1% of the whole country.
Exactly. Our buddy Shannon, we were actually just talking about this exact thing just this last weekend. And, the way that he was describing it is think about things in a pyramid. So, at the very top of the pyramid, you've got your most expensive properties, but there are only a few people that can actually afford those types of properties out of the whole population of the United States. As you go down the price range, you've got in the middle, you've got, more properties. They're still, quite expensive, but not like your high end. But at that level, naturally, there are more people that can afford that. And as you work your way down, there are just more and more people that are going to be effectively applicable
Yep.
For your end customer, whether your customer is someone who's going to be renting or whether your customer is someone that you're ultimately going to sell that property to. And so it makes all the sense in the world to go after that end of the spectrum where you're going to have more people that you can market your products to versus playing right in that top tier, because there's just not that many folks that operate in that stratosphere.
I agree. So what, any advice you have?
Sure.
For the people out here that are looking to get into it? Maybe they got 1 or 2 properties.
Mm-hmm.
Maybe they have no properties. Maybe they just trying to figure it out. Everybody tells them how great this field is. Real estate is awesome, and I agree with that statement. But real estate is also, you got to do your due diligence. You got to work really hard. If you're lazy, this is not for you. If you're lazy, because you got to be diligent about what we do, and that's what pays off. But any advice you can offer to people,
Yeah, for sure. I mean, I think there's a lot of advice after having done this for a few years, but I'll try and kind of boil it down to the most important pieces that I think are useful and that you can take home and take action on. So the first is around education. You've got to understand how this stuff works. So watching this video, listening to this podcast, going online and, following some folks on Instagram that are doing this at a high level, or on YouTube, getting connected with other groups of people that are actively talking about and investing in real estate. There's a great podcast called Bigger Pockets that I would absolutely recommend listening to.
Brandon spoke at the event. Was that this weekend?
Brandon Turner spoke at the event, and yeah, absolutely. I mean, he was there, and but ultimately, at the end of the day, what you need to be doing is learning the lingo, understanding how this works, and just like, bombarding your senses with this information, because you will learn through that process. It's incredible how much you can teach yourself through online.
So off the wall question.
Mm-hmm.
Everyone looking at this video is looking for ways to learn. They're out there looking at, it seems like everybody that is on YouTube, quote unquote influencer, everybody's got a program they're selling, everybody's got something they're pushing, everybody says their product is the best. How does somebody that's watching this video right now decide, what do I go buy?
Yeah, I mean, frankly,
that's a good question, but it's
a really hard question.
It is a hard question.
I think, from my experience, there's a lot of stuff that's out there that's for free. So that's number one. And I would start there. I mean, you don't have to go in and pay $5,000 for some internet guru to tell you how to do, X, Y, and Z. There can be value in those programs, but I would say there's a lot of free content that you can start with. And then what I would start doing is, as you start to get a little bit more experience, and as you start to have conversations with other people about real estate, find out what they're doing. How are they learning? How have they, what programs have they taken? Were they good? Were they bad? Were they indifferent? So I think the more you start surrounding yourself with people that are doing this, the more you start having these types of real estate conversations, that will naturally start to uncover the ones that you should stay away from, and the ones that you want to look at with a little bit more, with a bit more confidence.
So skeptical. I'm so skeptical. And I joined Rich Dad Education in 2013, and right after I joined, Robert Kiyosaki sold Rich Dad Education, or sold the name for another company to use for, 6 or 7 year period of time, or whatever, 10-year period of time, whatever it was. So my program when I bought in was $40,000 for classes. Classes, $40,000. I could attend each class 3 times. I bought it, and it was like, you ever been to a timeshare sale?
I haven't.
Oh my goodness. Bam, bam, bam. And all right, bam. You're so hyped up. You don't ask the right question. Unfortunately, I had a company that made money, so I wasn't broke. I put it on my credit card when I bought it.
Yep.
And then I go the next month to attend the first class. Well, there's no class in Tennessee.
Oh, no. So you had to travel?
The class they were doing was in Texas.
Oh, geez.
So I called them up. I said, when is the class in Tennessee? Because you got 3 years to use everything. I said, when is the class going to happen in Tennessee? Well, we don't have anything scheduled for Tennessee. So I said, okay. You could do the online classes if you want. Well, I didn't buy $40,000 of the product to do an online class. I'm an in-person guy. I got to ask questions, got to see people, got to talk to people. I want to feel people out. So I flew to Dallas, Texas. I did the class. And then next month, I flew to a different state and did the class. And I did that 36 months in a row straight. I flew to a different state, and I attended a class in a different state. And it was in places like I always stayed this weekend, $400 a night for the room.
Yeah.
$250 a night for the room. And then you got to buy all your meals, and you got to pay for this, and you got to pay for that. And they were always selling something else too. But I'm going to tell you, I'd have paid $1 million for the class today if I got the same content, because I have made millions on top of millions on top of millions of dollars from what I learned from those classes. Now, the education, I think, went to the crapper in the end, and I would not recommend it buying it. And I'm not saying I don't recommend Rich Dad Education. I don't know where Rich Dad Education is anymore, because I know Robert Kiyosaki's got his name back and they're doing something different. I don't know what that is. But at that particular point in time, at the end, it wasn't, they were selling people packages and didn't have the people that could teach it. And most of the teachers did not have experience. They weren't ready.
Yeah.
So it's a very skeptical place. It's very scary to be. And I don't know. I don't know what, I have people ask me all the time, what do I need to do? And it is an absolute struggle.
Yeah.
And that's, that up there, the little diamond thing up there, I think it may show in the video, but that was where I made the Hall of Fame with them back in 2016. And so, I mean, it was definitely something that was beneficial. But just vet everything that you seek. Do not make a spur of the moment thing. If they're pressuring you for money, do not buy. Anybody that pressures you for money, don't buy their product. I mean, their product should stand for itself. It should stand alone. Look at reviews on it. Look at what you're getting. And, what is their experience in it? Everybody, I feel like everybody today, they can go to ChatGPT and write a program.
That's right.
This is what I'm going to do.
Mm-hmm.
But, is it going to work? I don't know. It might work. But have they done it and proved it? I don't know that either.
Yeah.
And
you definitely need to kind of vet the corporation or whoever it is behind the education. And I think you're absolutely right. I mean, if they're actual people that do this themselves as opposed to just teach it, then you're going to have that extra level of comfort that, hey, this isn't just theory. These are people that are actually doing this work in real life, and they're teaching people how to do it as well. If you can find an outfit like that, I'd say, okay, you're probably on the right track. So I think education, number one. Number two, I think, one of the things that I've learned is you got to figure out a way to get in the game and just get started. It's really, really easy with all of this education that we're just talking about to study. You take these courses, you read these books, you listen to these podcasts, and you can do that until you're blue in the face. But until you actually start taking action and start chasing after some deals, that's really where the rubber hits the road. So
that is where most people fail.
That's where
they cannot take that first step.
We were just talking this weekend about that buddy of mine, remember? And prime example. But at the end of the day, you got to get in the game. And what I'd say, for most people, and I struggle with this a little bit in the beginning as well, like one of the big challenges, if you're going to go down the route of putting debt financing on the property, is coming up with the down payment. So typically speaking, let's say a bank's willing to loan you 70 to 80% of the total purchase price. You've still got to come up with that additional 20 to 30%. Now, there are ways to do that creatively, to bring on partners and so on and so forth. But if you're not going to go down that route, you've got to figure out a way to pony that up. So my advice is build yourself a budget, figure out where you can, kind of trim a little bit of the comfort factor in your life and just start saving. Set up your bank account to, instead of like every month, just put, $500 a month or whatever it is into a separate account, whatever you're able to afford. It doesn't matter the number, but put that into a separate account that's not linked to your online banking. So you can't touch it and you can't see it on your phone. And, in time, that'll add up.
Beans and rice. You don't eat out. Don't go eat at McDonald's or Hardee's. Save your money. Do everything in the world to save.
Exactly.
How bad do you want it?
Exactly.
Really, how bad?
So, and that can be two things, right? It can be looking at your expenses, and I advocate for doing both. Like, look at your expenses, see where there's excess money that you can, cut back on some of your lifestyle, perhaps for a period of time to help, contribute to that fund. And then number two is figure out a way. Like, is there a way that you can, earn a little bit more money? Can you take an additional job? Can you drive? We're on the weekends. Is there something at your job? Can you ask for a promotion? Like, is there another job that you could, take within your company, or whether it's moving from the company that you're at now to a different job that can get you in a position to where you're earning more income? And then, by cutting your expenses and earning more income, that's going to leave more money to put towards a down payment. And, I can't speak strongly enough to do that as fast as you can, because you have to get in the game as quickly as possible.
That's my question when I get in an Uber a lot of times is, how long have you been doing this?
Yeah.
And I mean, a very large majority of the people we talk to have been doing it for a while, but it's not what they do for a living.
Mm-hmm.
I just pick up a couple hours at the end of the night, or in the morning, I pick up a couple hours before I go to work, and they go make some money with that, and
That's right.
and they just socking it away. That is a great idea. I mean, it's so easy to do.
Yeah, exactly right. And use your own creativity. Those aren't the only ways to do it, but however you ultimately get there, it's just about building up that nest egg as quickly as possible so that you can take that and use that for a purchase to help fund the down payment on your first purchase, or your third purchase, or your fifth purchase. It doesn't matter. But, the sooner you can do that, the better. Kind of like what you were talking about a little bit earlier with inflation doing its thing. And you think about in 5 years' time, properties that you buy today are going to look like an absolute bargain. You're going to look like a complete genius for buying in 2023, even though in 2023 it's expensive. Inflation's going to continue to do its thing. These properties are going to go up in value. And so the sooner you can get in on that, the absolute better.
So Ken McElroy was talking about this weekend in his expectations over the next 12 months was that, he didn't say interest rates were going down, but kind of suspected maybe they're going to go down a little bit. But what's the first thing that's going to happen when interest rates go down? Inflation's going right back.
Yeah.
That housing price is going right back up.
Yep.
Everything is going right back up.
That's exactly
It's based off of the cash flow. What are these properties making you on cash flow? And Jason Hartman uses it all the time. Right now, it's still at a discount. If you really look at how inflation has worked throughout the history of the last 50 years, it's still at a discount right now, even as high as real estate. Any closing remarks?
No, I think this has been great. Hopefully there's been some nuggets in here that you all can take away and take some concrete action on. And hopefully one of these days you'll have me back, Winston, and we can talk about where we're at, 2 years from now.
Been a great time, great opportunity. Just want to encourage everyone out there, if you like the video, like it. Share it with a friend. There's so many people out there that don't know who's legitimate, who's not legitimate. They can listen to us. They can look at our credentials of what we do. I mean, I'm really not here selling you anything in the world. I'm just here to share what we know and help you on your path to financial freedom and escape, hopefully, some of the pitfalls as you're going. There's a video I got out there that shows you how to go out and take a little bit of money of your own and borrow some money from a family member or something. Go look at some of the first YouTube videos I have, and you'll see some that'll help you figure out maybe a real easy way to get you started with very minimal cash, working with a family member or something like that. And I think them numbers, once you learn how to run the numbers, you really get to see the proof in the pudding, and it takes all the guesswork out of it. It takes all the fear out of it, and you walk into it with confidence. Just go get that education. And as Rob said a little while ago, the first step is just do it. Just get out there and do it.
Just do it for sure. And you know what? It's interesting. The first one is going to be the most nerve-wracking. I'll just leave you with that as well.
Yep.
Just because it's new. But what I found is after the first one, it's like, oh, this is actually working. Like, the sky's not falling. This is working great.
You wake up 12 months later, you're still making money every month.
Exactly. And then, you go into the second one and you run your numbers again, and it's like, oh yeah, I've done this before. It's like exercising, right? That muscle memory.
I failed when I got overconfident. That was my first failure, was when I got overconfident when I was doing it. Everything works. Everything does not work. You can, it felt like that a few years back. Throw a dart at a dartboard, anywhere it sticks by.
Yeah.
It was that way. That is not the way it is. It really isn't. We got to do better due diligence. So, but brother, thank you very much for your time. Appreciate you.
Enjoyed it.
Thank y'all for watching.